Okay, let's keep talking about things that can go wrong with banks. And in particular, I want to talk about loans and securities being risky, right? If we think of the last financial crisis, basically the problem was that we had bad securities, right? 2008, 2009, we had mortgage backed securities being not as safe as we originally thought. Originally, we thought, look, most Americans pay their mortgages, and so these mortgage backed securities are pretty safe, and we can buy them and hold them safely. Well, let's suppose they're not safe, and that we find out that instead of being worth 900, these securities are really only worth, say, 600. They've lost two-thirds of their value. Well, how does this change things? Now we've got 1700 here. If I want to keep my assets at 1700, my liabilities have also got to be 1700. Well, the problem is I still owe my depositors 1400. I still owe my creditors 400. What adjusts is the equity. The equity is now minus 100 to get us back to our 1700. This is what we call bankruptcy, right? When the equity is negative, it means that the bank has more assets, has more liabilities than it does have assets, right? In this situation, the bank still has 1,800 units of liabilities, but only $1,700 in assets. So even if the bank sells all the loans, sells all the securities, pays off the depositors, pays off the credit holders, it can't. It's going to run out of assets before it can meet all the liabilities. This is a much more fundamental problem because time necessarily won't solve it. Before, in the liquidity crisis, it was just the bank needed time to liquidate the loans and securities and repay the depositors and the creditors. But now, time may not fix things. If those securities are just worth less, then we're stuck and the bank is just bankrupt. There's nothing that can be done in terms of time here. The bank has a fundamental problem. One thing you could do is you could bail out the bank by the government stepping in and buying the securities for more than their market value, right? If the government buys these securities for, say, 720, then we're saved. If the government buys them for 720, now this is going to go up to 1820, and we're going to have enough assets to repay all the liabilities, and this bank is no longer bankrupt, right? So when the government is buying securities, and especially exotic securities, ones where the market price is debatable in times of crisis, that's often what we mean by a bailout. That the government is maybe not paying fair market price for securities and is bailing out the bank by paying an above market price in order to prevent, admittedly, the bank from collapsing, which can be good for society. So this seems really bad. We don't want banks going bankrupt. So how do we regulate banks to try and encourage them to rely more on their own strength as opposed to government bailouts? Well, most of what we do is now we regulate the amount of equity. This is the prime target for regulation. We want to make banks hold a lot of equity because equity is the buffer for shocks. When something bad happens, you can see that the equity gets affected, and when that equity goes negative, really, really bad things happen. So if we force the banks to hold more equity, then the shocks that hit the bank might not be as bad, right? Suppose here, if the bank had relied less on borrowing money and had held more equity instead. Now, when these securities fall by $300, the bank is still fine. The bank can survive this minus $300 shock from its securities portfolio falling because the bank's owners have more skin in the game and they lose the money, right? The people that we're worried about from a public policy perspective are the depositors. We want to make sure that the average person on the street is insulated from banking crises. And banking insurance, deposit insurance only really helps with the first liquidity rush. It doesn't help as much with this equity issue where there's simply not enough assets to pay people back. So the more equity we regulate in, the more money that we force the owners of the bank to put in, the more shocks, the larger shocks that the bank can withstand before it goes bankrupt. Further, we also like to think that equity regulation provides good incentives. When bank executives and bank shareholders have their own money at stake, they're going to maybe play it a little safer, think through things a little more conservatively, not take the same risks than if they're playing with other people's money, right? Banks with very, very little equity are banks who are speculating with other people's money. If I get to play roulette with someone else's money, I'm going to follow a very different betting strategy than if I get to play roulette with my own money. In either case, I get to keep the wins, but if I'm playing with my own money, I have a lot more to lose, and I know that could be a big problem. Some people say, well, look, we could also just regulate the securities. Why don't we just regulate what banks are allowed to hold? We could regulate the asset side. This is, I would say, also a popular approach, but economists tend to be a little more skeptical. In part because if you really try to dig into a bank statement, this gets very, very complicated. There are many, many, many types of financial assets out there, and it's very hard to keep track of them or understand them or to appreciate what they are and how risky they are in different economic circumstances. Going into the mortgage crisis in 2008, 2009, nobody thought these things were particularly risky. So the problem was, if you can't predict what things are risky or you can't predict what the future economy holds, understanding how you should regulate the asset side of the balance sheet, loans and securities, is going to be really, really difficult. But if you regulate the equity side of the balance sheet, basically you say that, we don't know what's going to happen, but we do want a lot of protection, right? Equity is like building a big wall against a flood. It doesn't matter what causes the flood, having a higher wall is better. So most of the regulation, as we're going to see, the core thrust of banking regulation is to force banks to hold lots of equity and to make the owners of the bank put their skin in the game and make them think seriously about how much risk they're willing to take on the asset side of the balance sheet. Because if their assets go bad, the first thing that's impacted is always the bank equity, and presumably that should align the incentives of banks with the banking regulators.